Welcome to another exciting episode of the Entreprenudist Podcast, a place to hear real entrepreneurs and business owners bear it all. And this episode is no different. I'm going to have fun talking to this new entrepreneur that's decided to grace us with his presence. Before that, I want to make sure that you know that the Entreprenudist Podcast is sponsored by Shearwolf Strongholds, a wealth growth and wealth protection company. If it's employee benefits, if it's estate planning, if it's retirement planning, if your plan ain't Shearwolf, your plan ain't strong. Now to our guests. Meet Cash Flow Mike, a business advisor, author, and the creator of The Clear Path to Cash. He's trained over 25,000 business owners, accountants, and bankers, uncovering more than 150 million in hidden cash. Mike helps listeners understand their numbers fast so they can grow profit, improve cash flow, and build a more valuable business. Welcome to the Entreprenudist Podcast, Mike.
Hey, live from San Antonio is Cash Flow Mike. You know, you ready? You have the best podcast name in the business. I've got to tell you that right now. I've been on a lot of podcasts. You have the best one. So I was like, what? I get to be on that one? I'm in.
I appreciate that, man. To me, you know, I'm always marketing first, right? And I thought, all right, well, how do I differentiate myself? How do I separate myself? All right, and what's a good play on words? I don't remember what the first thing I came up with, but I do remember that it wasn't available. The second one was the Entreprenudist Podcast. And I say, well, that's clever. Everybody's going to know that I'm saying entrepreneur, just sharing and bearing everything. But no, you got to add on that colon for real entrepreneurs and business owners to bear it all. But I've had people that said they've come to my podcast because they truly thought this was a nudist podcast. And I'm assuming that's why you came.
Yeah, of course. I mean, that's the first thing I thought. I was going to say, okay, well, maybe I'll just bear it all. And then I thought you had a shirt on it, so I put mine on real quick.
Absolutely. Actually, I have one episode with a good colleague of mine, a good colleague and friend, Mark Goldwich. He came with his shirt off. That sounds wrong. No, he showed up to the podcast with his shirt off. He's like, oh, I thought this was the Entreprenudist Podcast. So that was a hilarious episode. Definitely.
That's a thing now. You see that, right? All the college kids, when they go to the football games, they're getting up in the farthest corner of the stadium and they're all taking their shirts off, right? And I blame Pat McAfee. He was doing that stuff on College Game Day, so I blame him.
Do you blame him or do you credit him? I guess it depends on where you live.
It depends, right? It just depends on, on what you see.
Absolutely. And it's all perspective. And I'm assuming that's one of the things that we're going to get into, because cash flow is one of those things that people either consider impossible to get or they consider it. All I did was step into the stream of this optimism and possibilities and relationships and communicating with people. So I'm hoping that we're going to have a good conversation of how to frame these things to make it seem more easy than hard, or maybe it should seem hard. I don't know. Is there nothing that you know now that you wish you knew when you first started?
Yeah, I've got to tell you, I mean, money has an energy. I don't know if you realize this or not, but there's a whole energy around it. And, whether it's a positive energy or a negative energy, it depends on you, right? And what you're feeling about money at the time. If you don't have any, that's probably negative. If you have a lot, maybe you're starting to get a lot, maybe it's positive. But here's what I can tell you. You cannot chase money. You have to attract it. Every time you chase it, you're going to fail. It will outrun you. So you have to attract it. And I think that's what I like about you and your marketing, because that's one of the ways you attract it to yourself.
Mm-hmm. So is that something that you had to learn over time that, all right, I can't chase this money. I have to attract it to me?
Yeah, absolutely. I mean, people think about, like sales. One of the first things in business that's the hardest to do is your first sale, right? I mean, think about that. It's like just to get the ball rolling. It seems like it takes forever sometimes. And sometimes it doesn't. I actually got lucky in my very first business where I experienced a phenomenon called growing broke. You ever heard that? Growing broke.
I haven't. Please elaborate.
Yeah. So most people think about cash flow as, I'm struggling. I don't have enough money because I can't make enough sales and I can, maybe I'm spending too much or whatever that is. But there is an opposite side of that where you're actually successful and you still run out of money. And the way that happened to me, and I built 14 companies, right? So I built 14. And the first one that took off was a hotel staffing company, right? Where I just provided like heart of the house type of positions, like housekeepers and housemen and dishwashers.
Human capital.
Yeah, just people doing a job and making a living. So with that, you can actually, if you do a good job, just getting people to work, just getting people, to their job, other hotels will hire you. I mean, just instantly, because they're always looking for another person. Well, I ended up opening 27 offices in 9 states in 3 years, right? Because I became a preferred vendor of Marriott. And when one Marriott manager talks to another, I mean, it just spreads. I mean, sometimes
you're not ambitious at all.
Yeah. I mean, well, I there's a difference between push and pull. It wasn't me pushing my message out into the market. It was them pulling me into the market saying, no, we need you, right? And here's what happened. I thought, well, if I just sold more, I would solve all my problems, right? Because I was struggling making payroll, because you got to look at it. When you have a staffing company, I got payroll that comes out every 2 weeks. Well, here's what you don't realize, that sometimes when you deal with bigger companies, your dream of dealing with a Marriott or a Hyatt or Hilton or somebody like that becomes a nightmare, because they're going to pay you in 2 to 3 months. So think about that. I got to cover payroll.
Net 60, net 90.
Yeah, right. So, but think about how many times I got to make payroll while I'm waiting to get paid for that first one. So the work I did in January, I'm not getting paid for till March or April. I still got to make my payroll. So what I realized then was every new sale wasn't a win. It was digging me a hole, which means if I sold a new hotel as a client, I had to pick up 3 more months of debt. Right. So it was actually digging a bigger hole until I could let money catch up. So, I mean, that's where I learned a lot about cash flow, and the timing of money coming in and money going out was just understanding that principle. It's called the financial gap.
And something I always look for moments to, create like a clip, right? An education thing. A lot of people aren't familiar with what you just said, the net 30s, the net 60s, the net 90s. Can you elaborate a little bit on what that means? And I know it affected you, because what you're saying is, all right, I just got a new contract. Because of this new contract, I have to put people on the ground immediately. I'm paying them bi-weekly, but because I have net 60 or net 90 contracts with these facilities, I'm paying these people bi-weekly, but I'm not going to get a return until at least 60 to 90 days from now. Can you elaborate exactly a little more on the net 30, net 60, net 90 situations when you're working with big companies? Yeah.
So, basically what you're talking about is that let's just tell this story, right? So I have an employee that Marriott wants. I put them inside their building. They work Monday through Friday. At the end of Friday, I've accumulated all the hours that my employee has worked, right? So I'm going to owe them the money for working those hours. Well, on Friday, I send Marriott an invoice. Here's all the hours that, you worked last week and, with my employees. So you owe me, I'll say it $1,000. Well, I owe the employee, we'll say $500 or whatever the number comes out to be. Well, the very next week, the second week, the whole cycle starts again. The employee goes to work, and at the end of the week, I send another invoice. So now Marriott has 2 invoices, but I owe 2 weeks worth of work to that employee, and I have to pay today, right? At the end of the second week. So my $1,000 comes out, and I've got $2,000 I'm waiting for from Marriott. Well, that continues over the next 2 to 3 months. That net 30 means 1 month. Net 60 means 2 months. Net 90 means 3 months. Well, if I'm paying twice a month, I might have 6 paychecks at $1,000 a paycheck out before I get paid for the very first invoice from the very first week. So you have to have enough money to cover all of that payroll. If you have inventory, add inventory on the front of that. because I got to buy the inventory. Then I got to wait for somebody to buy it. Then I got to wait for them to pay for it with an invoice, right? So, I mean, the whole cycle gets elongated. Now, when I talk about the financial gap, what I'm talking about is the difference between money coming in and money coming out. It's an amount of time. And when you think about a gap, you want to jump over a big gap or a small gap?
Small gap.
Yeah, because it's easier, right? That's the same principle in your business. The smaller the financial gap, the easier it is to run your business because it takes less money. So that's basically what I'm teaching people is how to do that calculation of the difference between money coming in and money coming out. So if it takes 60 days to get paid, but I'm paying every 30 days, well, there's 30 days that I don't have enough money. I have to have that in cash or what they call working capital.
So hence growing broke. In retrospect, is it just if you're going to deal with a big company, you just got to deal with the long nets? Or in retrospect, did you learn a better way to do it?
Yeah, there's an actual calculation, and math is never good on a podcast, but but I'll tell you how to calculate it, right? If you're in a service-based company, we'll just say service to begin with, which I was in a hotel staffing company. If you're in a service-based company, you're going to calculate up how long it takes you to get paid on average by all your customers, right? So, and that's, sales divided by your accounts receivable. So accounts receivable on the balance sheet, sales from the income statement. When you divide that, it gives you a result, which is kind of a turnover rate. You multiply that by 365 and it converts it to the number of days that it takes you to get paid. So sales divided by accounts receivable times 365, and it gives you a number. Let's just call it 90 days, just as a thing. So I get paid on average every 90 days for my customers. Well, if I'm paying every 14 days, right, how many times I divide 14 by 90? And we'll just call it 6 because it's twice a month, 3 months. We'll call it, or 9 times, I guess, right? Is that right? 3, 6, 9. Yeah, 3, 6, or 2, 4, 6, 6. I can't even do math on a podcast.
I was just going to say yes to anything you said.
Yeah. So it's 6. So I got to make 6 payrolls before I get paid. So if I'm thinking about taking on a new contract, let's just say it's a new contract somebody wants me to give, I got to know how much money I'm going to have to spend in payroll up front before I get my first paycheck from the client. So that's where most people go, no, I just want the sale. Well, if I get the sale, I just dug a 6 paycheck hole. I can't sell my way out of a hole. It's like if you dig a hole, you can't dig yourself out of it. And you have to actually fill the hole up with money. Well, that's called working capital, and that's generally the amount of money that you have or the amount of money that you have available with like a line of credit. So that's one of the things. I mean, the financial gap is theoretically the amount of time where you don't have enough money. You're broke, right? Because if you don't have cash or you don't have a line of credit, you can't make your bills, right? You can't pay your payroll. You can't pay your rent, those type of things.
And speaking of gaps, a lot of people don't like gaps in conversations, right? And even when they're talking to potential prospects or potential partners and collaborators, that initial conversation can destroy any potential prospects or make it almost inevitable that something is going to happen. Might not be immediately, but sometime in the future. What's the 7-minute conversation?
Yeah. So the 7-minute conversation to me is most of the time when I have clients that don't have a business background, they'll come to me and say, hey, my accountant keeps giving me these reports. I got I've got this income statement. I got this balance sheet and a cash flow statement. What do I do with these? What am I supposed to do? Right. They don't really know how to use them. They just know what they're looking at. Well, the 7-minute conversation is a 6 calculation technique that I teach people that just basic math, right? You don't have to be somebody that knows calculus or, can use, whatever that is, a protractor for geometry. You don't have to know that stuff. It's just basic addition, multiplication, those type of things. But it teaches people how to read their financial statements in 7 minutes or less. And I call it the 7-minute conversation because that's basically what I'm asking you to do is every month have a conversation with your financial statements on what it's telling you, right? Because they're trying to talk to you. They're trying to show you that, hey, this is good, this is bad. You just got to be able to look in the right places and understand what it's saying. And most people don't. So it's the 7-minute conversation is a course I just give away to people, right? So if you go to my website, cashflowmike.com, you can get a course. It's a video, it's worksheets, it's a copy of my book, The 7-Minute Conversation, that teaches you these 6 calculations, and it's a little bit from each one of those statements, a little bit from the income statement, a little bit from the balance sheet, a little bit from the cash flow statement.
Okay, and usually you have a conversation, a dialogue, or a monologue, right? And it seems like I know how the papers are communicating. How is the actual business owner expected to communicate in that conversation?
Yeah. So basically what we're trying to do is that we listen to the story, right? Every business has a story. So you're listening to the story, and things that you should be listening for is, what should I do next? Right? You're not going to see it in the numbers. You're going to see the numbers and probably go, I don't know, it just looks like math to me. But they're really telling you your financial story, and warning bells are going off or confetti's going off. It doesn't matter. I mean, it's going to be one or the other. Well, what you're listening for is, what should I expect? Right? And, is this good or bad? Those are 2 questions you need to be asking yourself while you're looking at your financial statement. Is it good or bad? And did I expect this?
And that's actually, that actually drives your metaphor home to me, because I'm imagining, just off the conversation that you and I had before we started recording, and just off your energy, and based off the way you just described it, the best conversation, whether it's with anybody, another business owner, another prospect, anybody, the best conversation is you listening more than you talking. And it sounds like what you're saying is, it's a conversation with your statements, but you're listening more than seeking to add, your emotions into it.
Yeah, so, man, that's really powerful and astute that you picked that up, because there's only one way feedback that's coming. It's your statements telling you the story, right? But we're not really listening to it because we're not tuned in. I always tell people, I said, if you want to see things differently, you got to look at things differently, right? I mean, if you look at a picture, right? Have you ever seen one of those pictures where there's something in the foreground and something in the background, right? When you don't know what you're looking at, most people focus in on the foreground, just what they see right in front of them. But a lot of times the story is behind, right? So if you change what you're looking at, you'll see things differently. And that's basically what I'm asking people to do, is take a logical approach to business where you're using it. And you know what's funny? You never asked me this, but my first job was, I was a state trooper, right? First job. I built 14 companies, but my first job was a state trooper, and that's where I learned math. You're like, oh, what? I tell people that all the time. I say, you're going to learn math today from a former state trooper. And they go, no. I said, wait, yeah, because here's what happened. You remember in high school, college, you're getting X's and Y's and Z's, and everybody gets confused. And the only way to learn math is through repetition, right? That's the only way you can learn is I just got to memorize this equation. Well, being a state trooper, they sent me to this thing called Accident Reconstruction School, where you would actually create diagrams of what happened and determine, based on the evidence on the ground, what happened during this motor vehicle accident. Well, here's the thing. That's where math came to life, because they would say, hey, if you measure that skid mark and you determine how slick the surface is, by using this little drag tire, well, because grass is like slicker than asphalt, right? And those type of things. It will tell you the minimum amount of speed that it took that car to be traveling to go that far on the skid. So I'm like, going, wait a second. That's how math is supposed to work, that I can see and put my finger on physical things around me in the world, and then math will come to life, right? I mean, I was doing math and didn't realize. I was doing complex math and didn't realize it. Rise over run type stuff, right? On launch angles and ramps. Well, I took that same logic and put it into business. I started measuring everything I touched and how long it took to do this and how many dollars I got if I sold one thing. I mean, everything became a physical touch type of environment. And that's where math came to life.
Oh, yeah. Whatever you measure gets better. Whatever you measure and report gets exponentially better. Right.
Yeah.
And that said, I'm imagining that there are a lot of business owners that are sitting on a lot of cash where would you say is the first place they should look to find it?
Yeah, so I got this technique I call mining your business for hidden cash. You got to realize that companies move in all directions at once, and people generally look at ratios in silos, like one number or one ratio at a time. Well, I look at it as 6 calculations at a time, and 3 of them are cash generating activities, like from sales down to profit, right? It's kind of a vertical analysis. I start with sales, subtract till I get to profit. The other is cash conversion activities. How long does it take for money to come in? And you got to look at those together. How much is coming in and how long does it take for it to come in or go through the company, with it going out? So the most common places where money leaks, right? One is we're not generating enough sales with our stuff, right? Every truck should generate a little bit of something, right? Every building should create revenue for you. The only reason to buy an asset is to generate revenue and profit. So that's one. Gross profit is how we price things, right? And you need to price things, either in line with the market or enough to cover your cost and create profit for you. The last thing in cash generating activities is how we spend it. So gross profit is the money we have to spend, not sales. People go, oh, you don't have enough sales. Sales is only a measurement of how much work you did. Gross profit is the amount of money you have to spend on your operating expense and put in your pocket. So those are the 3 things I look at there. The next 3, if you have inventory, how long does it sit? Because there is a calculation that tells you how much you should have of every single item. And it's called PAR, periodic automatic reordering. And it's how much do you sell per month divided by how many times I can get it per month. Right. So I know I'm doing a lot of math on your podcast, but I think.
So this is what we need because, my audience is primarily business owners, advisors, people in a lot of industries to where they're going to eat this stuff up, man. So keep it going. Oh,
good. All right. Well, so when you do that, we'll just take maybe, and I own 3 bars in St. Louis for about, 10 years almost. So we'll say I sold 200 cases of Budweiser a month. Well, if I can get it once a week, I take 200 divided by 4 because it's once a week, 4 times a month. That's 50 cases. So that becomes how much should I have? We get into a trap where we just order what we want and we accumulate too much and it sits too long. So if I know I need 50, that's all I order. If I have 60 on the shelf when the order is time to order, I don't order until it's below 50. If I have 30, then I order back. So it teaches you how much to have. Then it's AR days, your accounts receivable days. How long does it take for my customers to pay me, right? And we generally want to be paid faster than slower. And then the other one is how long does it take me to pay my bills, right? And you want to pay, believe it or not, a little slower and keep cash in your company a little longer. That's why people call it stretching payables, because it keeps cash in your pocket for just a little bit longer. Now, those 3, I'm going to tell you, inventory, accounts receivable, accounts payable, they're double-edged swords. You can be too good and it hurts you. You can be too bad and it hurts you, right? You have to kind of find that sweet spot, which is around the industry average, right? And your banker or anybody around you, or I've got it built into my software, industry averages on for you to gauge when I'm getting too good or too bad, right? And you're like, well, how can it be too good? Well, like, let's say you're really good at getting paid. Right? You're better than everybody else. You get paid in 10 days. Everybody else gets paid in 40 days, right? Faster money is better for you. Well, what you don't realize is that your customers have a choice. They might not like how aggressive your payment terms are. Maybe you collect half up front and half in 10 days. Or maybe you send them an email, then you send them a letter, then you go pick up their kids at school and deliver their kids with an invoice. That's pretty aggressive. I'd be mad if you picked up my kids at school and brought me an invoice, right? But what I'm saying, when you're too aggressive, customers have a choice. They can go to somebody else who's a little bit more lax, and they're like, oh, hey, that guy doesn't even call me until it's 40 days, right? So that's how it can hurt your sales, because people have a choice. The other way, if you're too slow, where you're letting them just hold your money and you're having to foot the bill while you're waiting for money to come in. On accounts payable, same thing, right? If you're paying too fast, that's money you don't have to use to do other things. If you're paying too slow, that might hurt your relationships with your vendors, right? Which means they can move you to COD or drop you as a customer or give you worse pricing. So the sweet spot for those 3, inventory, AR, and AP, is around the industry average, because that's what the market expects.
And the more you talk, the more it's obvious that you dealt with a lot of industries that deal with inventory. I try to stay away from the inventory side of things because I be trying to avoid all these calculations that you do off the top of your head. Seems like you've worked with or helped you. Yeah. So because me, I'm like, all right, let me sell insurance because that inventory, I don't have to do the calculations. But you've worked with or helped over 14 companies. What are some of the biggest lessons you learned about cash flow and value creation? Is it what you've already said, or were there other hidden gems when it came to cash flow and value creation that you discovered with those 14 different companies?
One of the biggest lessons I learned that I teach in my course at Clear Path to Cash is called expense control, right? And you're like, oh, I know expense control. Well, I'm going to give you a mathematical formula about expense control, right? So remember we talked about gross profit. Right. Mm-hmm. Gross profit is the only money you have to spend. Operating expense is how you spend it. So the rule is this: when gross profit decreases, reduce operating expense by the same amount, and you'll make the same profit no matter the sales level. So if gross profit comes down $10,000, you reduce operating expense by $10,000 and profit is the same. Now, I challenge you. Try that on a piece of paper. Just take $10 million in sales and reduce it to $9 million in sales. And if you follow that rule, you will make the same money. And it doesn't matter what your sales level is. Right. So just try it on a piece of paper. It's like, I'm going to test Mike out. I'm going to test him. Right. So, but here's what I can tell you about this rule. If you violate this rule, you don't make that adjustment, you will kill your company. Right. And you'll kill your company. Yeah. You're like, oh, and I got your attention now, right? You're like,
okay, so sounds what you said. All right, my gross profit is $1 million. My operating expense is $250,000, and it sounds like what you're saying. If my gross profit drops to $900,000, which is 10% drop, then my operating expense should drop by 10% as well, which is $25,000.
No, it's dollars, right? So I don't talk to my clients in percentages because
got you
dollars. Right. If you reduce gross profit by 100,000, you have to cut operating expense by 100,000 and profit will remain the same. So think about that. 9 minus, we'll just call it 2, 9 or $1 million in gross profit, and you have 200,000 in operating expense. That means you have 800,000 in profit, right? So if you reduce that by 10%, we'll just say to 900. And then I take my 200,000 and reduce it to 100,000. Now I got 9 minus 1. I still make 800,000.
Okay, so I'm going to ask you the next obvious. I'm going to ask you the next obvious question because that makes perfect sense, right? If you're bringing in less money, reduce your operating expense by that same amount. All right, they're going to say, "Great idea, Mike. What's the first thing I cut?" How do you determine the first thing to cut in expenses and operating expenses?
Yeah, so you have to determine what's a strategic expense and a non-strategic expense, right? And I've got a whole chart and a whole thing, but I'll try to make it easy for you. If we had a graph in front of us, it would say, can I afford it or can I not afford it, right? The top of the graph is can I afford it? And the bottom of the graph is I can't afford it. Then on the right and left, or the x-axis, will have I want it or I need it, right? So if I can afford it and I need it, I keep it. I cut everything else, right? And what you shouldn't cut are the things that drive your revenue. Do we got time for a story? I'll tell you a story.
Yes, sir.
All right. So 2008, right, when the bankers burnt the world down, I was running a bar in St. Charles, Missouri, right outside St. Louis. And it's kind of like this bar district. You know how there's like several bars right in a row and, you're all competing for the same customer that comes to the area. Well, in that time, because 2008 was kind of that real estate bubble crash type thing that the bankers created. Well, at that point in time, I had a bar and I decided to cut labor, which means as people quit or they attrited, I either didn't replace them or I replaced them with part-timers. If they were full-timers, we just brought in part-time. So I reduced my costs through labor. The person next door reduced another cost, which is a marketing cost. If you've ever been to a bar and they got karaoke or they got Sunday ticket, or they got a live band. Those are kind of like marketing costs because, they're there to bring in customers, right? Is what that is. Well, he cut the marketing cost. I didn't. I cut labor. Well, here was the scene. Here's what painted the whole picture for me. On a Saturday night, I walk up, I see both bars. Mine, lights, music, line out the door. His, 3 old guys watching soccer. So which one do you go into? Right? Now, me, I'm going to go watch soccer until the line goes down because I don't like to wait in line.
Clever man.
But here's the thing. When you take away people's reasons to come to your business or to buy from you, they're going to oblige. They're going to stop buying. They're going to stop coming. So don't cut the expenses that drive your revenue, or you're also going to hurt your revenue.
Oh, yeah. That's one of those things that sometimes people learn the hard way. Marketing is the last thing you should cut when things are going, quote unquote, bad. Right. Because like you said, people need to continue to have a reason to come see you. But you don't know what you don't know. Right. So and I'm imagining that's probably is that a part of what it's inspired you to write your book? Don't be a dumb business owner. And does dumb stand for what we think it stands for?
No. Dumb doesn't mean unintelligent. It means I don't understand my business. And that really came about from me. I'm sitting at the kitchen table and I'm pulling my hair out because I couldn't figure out this financial gap thing back in early 2000s. And I'm sitting there like going, man, I'm not dumb. I just don't understand my business. And you know how something just kind of hits you like, oh, don't understand my business. And so I'm like, oh, that's the book I'm going to write. And that came about just from, 25, 30 years of experience running businesses and making all the same mistakes. So that's 8 techniques in that book on how to maximize cash in a business.
Man, that's very powerful. Extremely. And one thing that I like to touch on is, because of course this is a business podcast, but I like to touch on things. How does your family feel about what you do?
Currently? Or back then?
Hey, 2 different things.
hey, back then, if you ever want to test your relationship, just start a business. Because, it becomes that thing that just kind of drives your life, right? I mean, it's always there. There's always a problem. You're always thinking about it. You lose sleep. You stress your finances, those type of things. So, but there's a point in time when you work through that and it clicks. And it's a discipline. It becomes a process. And that's where I'm at today in my career is that, I can shortcut because I've done it myself 14 different times. I shortcut a lot of the same mistakes I made in the past. So you get to success faster the more that you do it. It's just, I think it's just like being a basketball player, a football player. The more you kick field goals, the more you pass or catch a ball, the better you become at it. So in your business, treat it as a skill, treat it as a discipline, and exercise it on a regular basis, and it will get easier for you and your family.
What are your favorite vacations?
Mine? All right. So I'm a beach guy, right? So I like beaches. So I like, I actually like a little place down in Cabo San Lucas. It's called Playa Grande. My favorite place to go because I can unplug. I don't even take a computer. I don't take a phone.
Wow.
Well, I take a phone, but I don't take it out with me into the area, the pools and the beaches and stuff like that. So I like to just get away and be intentional. That's my word with my family lately is when we're together, let's be intentional, right? Let's be together and not together looking at screens. Let's be together with each other. And, even if it's sitting in silence, watching a TV together, we're not on the phones. We're being intentional, doing one activity together.
One last question. What's your definition of success?
Mine? Well, it's changed, every year, right? So, I mean, it changes every year. Mine today is time, right? I actually, as you can probably tell, if you can see this on video, I'm in the house in my place. I've created a room that I love to spend time in, but this is an office. So when I come in those doors, I'm at work. When I leave those doors, I'm not at work. And to me, I want to be out of those doors with those people that live in this house with me.
That's one of the things. One of my favorite books, The Greatest Salesman in the World by Og Mandino. He said, you got to divorce your home from your business and your business from your home, because if you don't, both will suffer.
That's right. I firm believer in that. That's wise. What's that knowledge there? That's wise knowledge.
Absolutely. Yeah. So now that we know your definition of success, Cash Flow Mike Milan, are you successful?
Totally. I tell you what, there is something about letting go, right? Meaning that, control what you can control and then just let the rest go, because all of the stress, it ages you. It makes you feel bad. It makes you cranky. It makes, it just builds upon itself. So the more you can let go, the more that, you're just really thoughtful and you're disciplined in what you do every day, the better off you're going to be. And I'm there.
And this is the real last one. Do you have a preferred person that someone should refer to you? Like who is the person that we should introduce Cash Flow Mike Milan to?
Well, my ideal customer, of course, are advisors, accountants, bookkeepers, those type of things. But I never shy away from helping a business owner that's struggling. If you're sitting there, right, and you're stressed and you get woke up in the middle of the night or you can't fall asleep and it's always on your mind, let me help. Right. I've got free resources. I got a free group on Facebook called The Clear Path to Cash. Let me help somehow. I can give you guidance. It doesn't cost you anything. Because again, you attract money. So it doesn't cost you anything to ask for help. So that's the one thing I'm willing to do.
Absolutely. The people that I've discovered that are really serious, the ones that are really doing it, they give their best information away for free. Because just like you said, when you teach somebody, especially in the industry that we're in, like we teach and we help business owners. The thing about, let's say if it's entertainment content, you just got your payoff. You laughing was the payoff, and then you're over with it. However, when you're working with business owners, when you teach them something, you just taught them something else that they just didn't realize that they needed.
Change lives. You change somebody's life, right? Sometimes just one piece of information unlocks a whole floodgate of blessings for him or her.
You don't know what you didn't know that you don't know, right? So one more time, Cash Flow Mike, please tell people who you are again and how they can get in touch.
Hey, I'm Cashflow Mike, and I can be reached at cashflowmike.com. And please take advantage of the free course, the 7-minute conversation. Learn how to read financial statements like a pro, like an investor, like a banker. And I trust you. You'll know more about your business in 7 minutes than you ever did in the whole time you've ran it.
Cash Flow Mike, thank you so much for appearing on the Entreprenudist Podcast, the place to hear real entrepreneurs and business owners bear it all. If you're listening to our voices, please don't forget to check the show notes where you can get more information about Cash Flow Mike. You can also get a link to watch the video of our beautiful ebony and ivory faces teaching you what you need to know to win all these races. Thank you, Mike.
There you go. You're the man. Thank you. Appreciate it.